Hello traders. So today I'm going to teach you guys the strategy I use in milking the market. I'm not a fan of overcomplicating things in the chart. Once you see my chart is always clean, and with a clean chart you can have a clean setup. So today I'll be teaching you guys the strategy in which I use to milk from the market. I'm an SMC trader and I'm listing out my 5 important points that I use to form my setup. You understand? So first of all, the first thing we'll be doing, I'm going to use an illustration first before we dive into the market, into the chart. So watch this video from the beginning to the end, to avoid mistake of any type. Okay guys, as I said earlier, the first thing I'll be looking for is our market structure. You understand? Now, what is the market structure? What is the market structure? Market structure simply means market breaking structure from the lower to higher, or from higher to the lower. Now, for example, when market starts forming something like a higher high, higher low, higher high, higher low, the market, which means market is breaking structure to the upside. This is a bullish structure. This is a bullish structure because of what? Market has been breaking structure. You can see it, market has broken structure to the upside. Market has been broken structure to the upside. This is a bullish structure. Now, a bearish structure means when market has been breaking structure to the downside. You see something like this in a bearish structure. Something like this. Lower high, lower low, lower high, lower low, lower high, lower low. This is a break of structure to the downside. You can see it's a break of structure to the downside. Now, in a system where the market is not breaking anything, market is just consolidating. It's what we call consolidating here. Market is just going from one point to another point without being able to break structure to the upside or the downside. This is also called consolidating. As simple as that. So now for my strategy, the first thing I need to do is to identify the market structure, to know whether the market is going to the upside or whether the market is going to the downside. As easy as that. If you can be able to identify that, then you have no problem in finding the rest. Understand? So now let me give you an illustration. Now, for example, now marking out our market structure. Now, to mark out your market structure, you need to start from the higher time frame down to the lower time frame. You understand? So now marking out our market structure, if in a case where the market has been breaking from the up to down, up to down, this is a break of structure to the upside. This is a break of structure to the upside. Then we mark out our structure like this. This is a break of structure. This is another break of structure. So therefore, from this particular chart, we are bullish. From this particular stuff here, we are bullish. Now, the second step for us to do is to mark out the origin that caused that break of structure, which is also known as our order block. Order block, the last consolidation. You understand? So this is our origin here. This is the origin that caused this break of structure. This is the origin that caused this break of structure. Now, the next thing we need to do is to find out our fair value gap. Import our fair value gap. So our fair value gap must be close to the origin, must be close to this origin or this order block. For my last video, I told you guys how to identify a valid order block. There must be a break of structure, there must be an imbalance, and the order block should not be mitigated. So this is it here. Our fair value gap should be something like here in the market for this particular structure to be valid. for this particular structure to be valid. You understand? So first of all, let's start afresh. We have marked our structure, a bullish structure. We have marked our origin, which is this particular order block here, and we have marked out our fair value gap. What is the next thing for us to do? The next thing for us to do is to sweep down to the 15 minutes time frame to find our liquidity and our entry. Once we are able to find our liquidity and our entry, we are good to go. Now, in the 15-minute time frame, you will see something like this. From here, you see something like this. Price go to the downside, move up again, go down here, move up again before tapping in here. Now, pay attention to this particular setup. This is what we call our liquidity. From here to here is what we call liquidity. This is our liquidity. So price has swept out the whole liquidity residing in this particular place, tapping into our order block, and this is where our entry point comes. Then all we need to do is just tap in here, put our risk reward ratio, and our take profit should be above here, and our stop loss should be below our order block. And all price need to do is to respect our entry and take us to the upside. As simple as that. This is the only strategy that we'll be using. As simple as that. So guys, now this is a clear example of what I've been teaching about. Now from our chart, you can see this is a break of structure here. Remember our strategy. Our strategy says, first of all, we mark out our market structure from the higher time frame. You understand? Now this is a higher time frame. This is the 4-hour time frame. We are using only 4-hour time frame and the 15-minute time frame in this particular range. So this is the 4-hour time frame, and we need to mark our structure. This is our break of structure. First of all, this is a change of character. This is our break of structure. And this is a recent break of structure. Mapping out our recent break of structure, what else do we need? Mapping out our recent break of structure, we need our step 2 says origins. We need to map out the origin across the break of structure. Our origin can be seen as order block. Understand? Order block, the last consolidation before the break of structure occurs, which is this particular area here. This is our order block here. This is our order block here. Yeah. Now, since we have mapped out our order block, what we need to map out again is what we call our fair value gap. Now, I'm looking at this particular chart. Looking at this particular chart, you can see our fair value gap is not close to our order block. This is the fair value gap here, and this fair value gap is not that close to our order block. So therefore, we're going to apply what the ICT call implied fair value gap. So I'm going to apply implied fair value gap. Don't worry, in our next video or soon I'll be teaching about implied fair value gap. But now, since we don't have our fair value gap in this particular area, all we need to do is to mark out this guy and this guy over here. Let me show you. Mark out this man over here and this man over here. So this will give us our implied fair value gap. You understand? So by using this particular entry for our example, by using this particular entry, and after getting that, you need to swift down to the 15-minute time frame to find our liquidity. Once we have gotten our liquidity, then we need our entry, and once I've gotten the entry, we're going up. Now, some of you guys might be saying something like influence. What our influence for entering this market? Yes, we need influence. We need confluences. Yeah, we need them to enter this market. But in a 15-minute time frame, we're either entering the market aggressively because we're in the 15-minute time frame. Once price pump into our entry, we wait for a change of character and so many things, and we are in. So let's go down to our 15-minute time frame. Yes, in our 15-minute time frame, price hasn't reached our entry yet, so we need to wait and see what price are for us. Okay guys, price just tapped our entry. You can see it here. Price just tapped our entry, and let's understand this market structure over here. Let's understand something over here. Now let's understand this. Now this is our order block that will map out from the 4-hour time frame. We map out this order block from the 4-hour time frame. So now let's understand. Since price is in our entry, liquidity. Now this is our liquidity. All these are our liquidity. All these are our liquidity. From here down to here is our liquidity, and price has swept everything down to the downside of this liquidity. Price has swept everything down to the downside. So now all we need is a change of character, a change of character to the upside. Then we are in on this particular buy. That's all we need. And you can see now I've gotten this bullish move. I've gotten this bullish move now, and this is our change of character. You can see it from here now. This is our change of character from this particular place. And this is a very big fair value gap. A very big fair value gap. So for us to trade this particular fair value gap, you need to pick up our Fibonacci tool and measure from the head to down of that fair value gap and pick out our premium zone, which is from here to here. Yes, this is our zone, and this is where we'll be setting our entry point. You can see our aggressive entry, and you can see our confluence. You can see everything here now. So we go our long tool, and our stop loss will be below this particular place. Our stop loss is supposed to be below this particular place, but we'll be risking too much. So our stop loss will be below this our entry here, and our TP should be as long as this. As long as this. As simple as that. So let's watch and see how it goes. So guys, this is our 2-hour time frame. Judging from the 2-hour time frame, you can see we are ready to go. We are ready to go already. So let's watch. Price has tapped us in. You can see this sniper entry. Price just tapped us in, and boom, straight to TP. As simple as that. If you don't understand this video, go ahead and watch this video from the beginning. Start the video from my head. You will surely understand it. Remember our 5 points: our market structure, our origins, our fair value gap, our liquidity, and our entry point. As easy as